You're watching a stock. It's been on your radar. You know the sector, you've done the reading, and you had a level in mind where you'd consider entering. Then it moves. Without you. Up 3%. Then 5%. And something shifts inside you. Not a thought, a feeling, a tightening. A voice that says, if you don't get in right now, you're going to miss the whole thing. That this move, this stock, this moment, it doesn't come around twice. So you buy, not at your level, not with a clean stop, at the top of a candle that's already extended, with a position size that doesn't match your plan, chasing a move that started 20 minutes ago without you. And 99 times out of 100, you buy the top. The stock reverses. And now you're not just late to a winning trade. You're holding a losing position with no real plan and an entry that was never about analysis. It was about anxiety. This is FOMO, fear of missing out. And the proof that it's costing you money isn't subtle. It's sitting right there in your trade log. In every entry you can't fully explain. In every position that started with, I need to get in before it goes further. Today we're going into what FOMO actually is, why it's driven entirely by anxiety rather than strategy, what it's specifically doing to your account, and the reframe that changes how you think about missed trades forever. Let's start with a definition, because FOMO in trading gets misunderstood in a way that makes it harder to fix. FOMO is not excitement about a good opportunity. It's not confidence in a high-conviction setup. Those are legitimate emotions that have a place in trading when they're grounded in analysis. FOMO is anxiety. Specifically, it's the anxiety of anticipated regret. The fear of how you will feel if you don't act and the move continues without you. It's not really about the trade at all. It's about avoiding a future emotional experience. And that distinction is everything, because it means the decision to enter isn't being made by the part of your brain that evaluates setups. It's being made by the part of your brain that manages social and emotional threats. There's research behind this. Studies on FOMO as a psychological phenomenon, originally studied in social contexts, later applied to financial behavior, consistently show that FOMO decisions are driven by a fear of exclusion, rather than a rational assessment of value. In social settings, that fear pushes people to join events they don't want to attend. In trading, it pushes them to enter positions their strategy never called for. The mechanism is identical. The cost is just denominated in dollars. And here's the part that makes it particularly damaging in a trading context. FOMO has nothing to do with your strategy. Your strategy doesn't know the trade is moving without you. Your strategy doesn't feel excluded. Your strategy has criteria, and either the trade meets them or it doesn't. FOMO enters the picture precisely when the trade doesn't meet the criteria, and the emotional response overrides that fact entirely. This is why FOMO trades almost always look the same in a journal review. Late entry, wide or absent stop. No clear thesis that holds up to scrutiny. And a P&L that reflects not a trading decision, but an anxiety response wearing the costume of one. To understand why FOMO is so hard to resist in the moment, you need to understand what's happening neurologically when it kicks in. Because it isn't a thinking process, it's a feeling process. And feeling processes move faster than thinking ones. When you see a stock moving sharply and you're not in it, your brain registers something that resembles social exclusion. This isn't a metaphor. Neuroimaging research has shown that the experience of missing out activates some of the same neural pathways as physical pain and social rejection. The brain doesn't cleanly separate financial exclusion from social exclusion. It processes both as a form of loss, and it responds accordingly. At the same time, the dopamine system, which we covered in the overtrading video's discussion of the boredom trader, fires hard when you see a rapidly moving price. Sharp momentum is one of the strongest triggers for anticipatory dopamine release. Your brain sees the move and starts projecting the reward of being in it. The combination of loss aversion firing on the missed opportunity and dopamine firing on the projected gain creates an almost irresistible pull toward entry. And crucially, this happens fast. Much faster than your analytical brain can formulate a coherent counter-argument. By the time you're asking yourself whether the entry makes sense, the emotional conclusion has already been reached. The feeling says get in. The analysis is working backward from that conclusion, not forward toward it. This is called post-hoc rationalization, and it's one of the most common and most expensive cognitive patterns in trading. You feel the FOMO pull, decide to enter, and then construct a reason. The chart looks like it could continue, the volume is strong, the sector is hot. That justifies the decision you've already emotionally made. The reason sounds analytical. It isn't. It's a story built to make an emotional decision feel like a rational one. Recognizing post-hoc rationalization in yourself is difficult, precisely because the story feels genuine in the moment. The test isn't whether the reason sounds good. The test is whether you would have identified this exact setup at this exact entry if the stock hadn't already moved. The title of this video promises proof, so let's look at it. The proof isn't a single dramatic blow-up. It's quieter than that, which is part of why FOMO is so insidious. It bleeds accounts slowly, one slightly wrong entry at a time, in a way that's easy to attribute to bad luck rather than a pattern. Studies on retail trader behavior find that chasing entries, entering after a significant move has already occurred, rather than at a planned level, produces dramatically worse outcomes than planned entries on the same underlying security. The average chased entry has a lower win rate, a worse risk-reward ratio, and a larger average loss when it fails, because the stop-loss level that made sense at the original entry no longer exists at the chased price. Think about what that means mechanically. Your original plan had an entry at a specific level with a stop below a clear structure. The risk was defined. The reward was proportionate. FOMO moves your entry point up, sometimes significantly, without moving your target. Your risk-reward has now compressed. Your stop, if you even set one, is either too tight and gets hit by normal volatility, or too wide and makes the trade a poor probability play. Either way, the math that justified the original trade no longer applies to the trade you actually took. And that's before accounting for the psychological cost. A FOMO entry that immediately moves against you produces a loss that feels different from a planned stop-out. It feels foolish, avoidable, and that emotional weight frequently triggers the next mistake. Holding too long hoping it comes back, or closing too early because the anxiety is already elevated going in. Run that pattern across a month of trading. 20 sessions, 3 or 4 FOMO entries per week. Each one with compressed risk-reward, a worse than average win rate, and an elevated emotional cost that spills into the trades that follow. The cumulative damage isn't in any single trade. It's in the systematic degradation of your results by a pattern that's present in almost every session, but never feels like the main problem. Because each individual trade seems explainable on its own. That's the proof. It's in your own journal if you're willing to look at it honestly. There's a specific belief that sits underneath almost every FOMO trade. It's rarely stated explicitly, but it's driving the decision every time. The belief is this: this trade is as good as it gets, and it won't come back. This particular opportunity, this particular move, this particular stock at this particular moment, it's a once-in-a-while setup, and if you don't get in right now, you've wasted something irreplaceable. It is almost never true. And examining why it feels true and why it isn't is one of the most useful things a developing trader can do. The reason it feels true is scarcity. Your brain, processing a sharp move in real time, is applying the same logic it uses for scarce physical resources. When something is moving fast and available now, the instinct is to act before it's gone. That instinct serves you well when you're in a store and the last item on the shelf is disappearing. It serves you terribly in a market that opens every trading day with new opportunities. The reality is that markets are not scarce. Setups that match your criteria appear regularly, not identically, but with equivalent or better probability profiles. The stock that moved without you today will set up again, or a different stock in the same sector will offer the same pattern next week, or the broader market will create conditions for an even cleaner version of the same trade in a month. The market does not have a limited supply of good opportunities. It generates them continuously across every session, every instrument, every time frame. The FOMO belief that this was the one, that missing it represents real, permanent loss, is a feeling masquerading as a fact. And here is the reframe that, once it lands, genuinely changes how you experience missed trades. A trade you didn't take cannot lose. A missed opportunity has a P and L of exactly 0. It doesn't hurt your account, it doesn't damage your statistics, it doesn't set back your progress. It simply didn't happen. The only version of that situation that costs you money is the one where you chase it. Understanding FOMO doesn't automatically stop it. So let's talk about what actually does. The first thing is written criteria with a hard entry rule. Your trading plan needs to specify not just what setups you trade, but where you enter them. A specific price level, a specific pattern completion, a specific condition that must be met before you pull the trigger. And the rule is simple. If price has moved significantly past your planned entry before you've entered, you don't take the trade. Not because the opportunity might not still be valid, it might be, but because the trade you'd be entering is a different trade with different math than the one your edge was built on. You pass. You wait for the next one. This rule needs to be written before the session, not evaluated in the moment. Because in the moment, your analytical brain is already compromised by the dopamine pull of the moving price. The decision has to be pre-made. You're not deciding whether to chase in real time. You already decided not to, this morning, before the market opened. The live session just executes that decision. The second thing is the post-FOMO audit. Every time you feel the FOMO pull, whether you act on it or not, log it. Write down the stock, the time, how extended the move already was, what you felt, and what you did. At the end of the month, go back and look at every entry you flagged as FOMO-driven. Track how those trades performed compared to your planned entries. What you'll find is that the data makes the argument better than any mindset coaching could. Your FOMO entries, in aggregate, will underperform your planned entries consistently, often significantly. Once you've seen that in your own numbers, over your own trades, in your own account, the FOMO pull doesn't disappear, but it loses authority. You've seen what it actually produces. And that knowledge changes the conversation your brain has with itself the next time the feeling arrives. That's the shift. Not suppressing the feeling because you can't suppress a neurological response. Building a pre-made decision that overrides it before it arrives and then building a data record that proves to your own brain why the override was right. FOMO feels like urgency. It feels like opportunity. It feels like the cost of not acting is real and immediate and larger than the cost of acting impulsively. None of that is true. The cost of not acting is zero. The market will open again tomorrow. Another setup will appear, not identical, but equivalent. Your edge doesn't expire at the close of today's session. What FOMO is actually doing, every time it pulls you into a trade your strategy never called for, is substituting anxiety for analysis. It's letting a feeling make a decision that belongs to a system. And systems beat feelings in this game, not because feelings aren't real, but because feelings optimize for the next 60 seconds, and systems optimize for the next 1,000 trades. The next time you feel the pull, the stock is moving, you're not in it, the voice says, get in now. Ask yourself one question. Would I have identified this exact entry at this exact price if I had never seen the move begin? If the answer is no, the trade isn't yours. Let it go. There will be another one. There always is.